a story we can go on and on. But since we are talking Biden, since we are talking Modi, since we are talking US, I think let's move to the US economy, should we? The US economy has printed an impressive 4.9% growth in the September quarter, beating expectations of most economists. Growth coming on the back of higher consumption and just days ahead of the FOMC meeting starting Tuesday, where a pause in the rate hike cycle is expected. US bond yields also coming in at a 2-decade high of 5%, with fears of a looming stock market bloodbath now more possible than ever before. Across the Atlantic, let's move to Europe. Eurozone is slipping. No more rate hikes, says ECB Commissioner Christine Lagarde. And a two-front war in Europe, Russia, Ukraine, and the Middle East continues to put pressure on oil. Are we looking at an uncoupled sort of a global growth GDP map, Rakesh? US growing 4.9%, impressive growth numbers, even though interest rates are high, 8% or so for retail interest rates. And on the other side, Europe, equally developed, great history of businesses doing well, slipping. We've seen Germany slip, we've seen France slip, and now the entire Eurozone, a pack of 20 large economies dependent on the euro, likely to go under in coming few months. Is this a decoupled sort of a world map that we are looking at now?
No, I think, the pointers are grave and grim. Let's not, anyway dilute them. But a little bit of a context is important here. It's not going back in history, it's going back to January 2023.
Right.
You remember we started the year with saying that India and China are going to drive the growth,
Absolutely.
while as US and the entire European piece.
US was supposed to be in recession already,
so in that sense,
3 months back, honestly.
And both US and China are both shown better than improved growth. The Reuters.
Well, China numbers made in China, coming from China, I don't know how much we should.
There isn't much difference. The Reuters independent poll, however, I don't know, I don't trust their access. But whatever it is, it said 4.4, it is 4.9. So it's a decimal point difference.
Right.
So in that sense, January 2023 and then the war, Ukraine one continuing and the fresh war, in that sense, these episodic growths cannot be missed. They're unmissable.
Right.
But there's a very interesting paper done recently, I think about a week ago, by the World Bank chief economist, who happens to be an Indian gentleman called Indermit Gill.
Yes.
I don't know whether you must have seen that.
Yeah.
So he has presented quite a bleak scenario. And I think one would be, keen to buy that perspective. I don't think he's being negative, but he's being realistic. So a couple of pointers. So any growth in the global economy is linked to trade and FDI.
Right.
These are two very, very big pointers.
Right.
So there has been a decadal slump in trade. Now the future production, even if it was about 4% in the era of 2000s, it is going to be less than 2% for the next 10 years.
Right.
So that's extremely dismal. Now, the other big challenge is it's linked to FDI. FDI in India has fallen. India was like one bright spot, but FDI, because you don't know where you want to go.
Right.
It's not because of uncertain policies in India, it's because of an uncertain global environment. It's because of US's own challenges, which you very well articulated. So FDI, trade is under pressure. The third big pillar he points out, which I and you have been discussing several times, is public debt. Public debt globally is at a phenomenal high.
Right.
India's own debt is 83% of GDP.
True.
And now if you add the fiscal deficit, which is again, it's an elephant in the room, it may not be seen like that big, but it's a challenge. India has done well to by and large keep it under control, but you never know when it will come out of the journey, especially with elections happening, this freebie politics. The combined fiscal deficit of states and center is again at an alarmingly high level. So fourth, which is the most important thing, is the private investment. If there was one element which was driving growth despite these, so to say, headwinds, was private investment. Globally, all that is coming down. Now, what is the response? The response is a country like Indonesia, which is also seen as an emerging bloc, raised interest rates to 6%, I think, last week, October 14th, when their inflation is at 2.3%.
Right.
So why are they doing it? They're trying to hedge against potential backlash, political backlash, if inflation raises its ugly head. Inflation is a global problem, with one exception, which is uglier, which is China, where you're, looking at the other piece. And coinciding with this, Karthik, is the other negative piece is, slump in consumption globally. There has been an uptick in the US economy, but again, it's episodic. I think, the choice of what you're spending in Europe and US led and is in contrast to what is happening in the emerging bloc.
What can US do right now, both at the monetary policy level or at the fiscal policy level, to spur up that consumption? Simply put, you the days of free money are definitely over. You could get a home loan, an education loan in the US for as little as a few decimal point percentage. I mean, it was practically free money. Today, you've got interest rates at 8%. Where is consumption going to come from? And interest rate cannot be cut down because inflation continues to be a worry. And 2% is the target of US Fed. It comes in at about 2.4% for the September quarter, not very away from the threshold of 2% that it has set for itself. But high inflation, and the CPI inflation, not retail inflation, headline inflation is much higher. So a 2.4% CPI inflation in the US, even a rate pause will keep benchmark rates in the range of about 5.25, 5.5%. Now, interest rates are going to be high. Where is US going to spur up this consumption?
Difficult. I mean, I don't have a solution, but I think, it's a challenge not just in US. I mean, Japan, for instance, with the lowest interest rates traditionally, has not been able to fuel consumption.
Right.
The one way of looking at it from a distance, I don't have data, is that there is a certain saturation in consumption there.
Right.
Whereas in India, there is a underlying, pent-up demand, which we are seeing.
Of course.
And that demand has its own contours. Like we keep saying that, we want to jump small cars, we want to jump small watches, we want to jump small houses, move into the bigger one.
True.
And so that aspiration level, even in US, from a consumption point of view, despite much higher per capita income, has a certain saturation.
Right.
And with interest rates, everyone wants to, just hold on. So that hold on sentiment will get aggravated to my mind. And I want to be a little cautious here. India is in a relatively better place, but we cannot guarantee that that we'll be in that happy zone forever. With elections coming, and you've seen what is happening. 500 rupees gas cylinder, which in the marketplace with subsidies costing 1100 or 900 rupees. So a whole lot of this freebie putting additional pressure on the system is going to cause problems, and there are independent writers who are talking about this middle income trap. It's going to be very difficult to get out of it. Moving from a $100 per capita income to $1,000 per capita income is relatively easy, as has the experience shown. But moving from $1,000 to $10,000 in the given situations, in a depressed environment, is going to be a thunderous problem.
Absolutely.
That's where India has a challenge.
It's weekend, I don't want to sound too somber and too dark with, whoever is watching our show. But I think one important implication on India, unmissable in fact, is the fact that US bond yields are also at 5%. A 2-decadal high. 23 years ago, we've seen rates breaching 5%, yield reaching 5%. Now, obviously, FPIs, FIIs, money, bulk of money coming into even Indian stock markets is going to move to US bonds. Safe haven, assured return, 5%, 10-year yields. I mean, they're big numbers and assured sort of, risk-free investment. Now, obviously, this is going to have an impact on Indian markets in addition to US markets because money is going to flow out from everywhere. But the worry is that this sort of yield is also going to put further pressure on discretionary spending by US companies. In an high interest rate cycle, US companies will find cost of capital to be exorbitantly high, may not want to expand, may not want to make too many investments. And India's already tepid sort of IT sector, which has been slated to look at a washout year ahead, could just run into that washout much quicker than expected. And hence, overall, bad news for India's growth, bad news for the Modi government in election year as well.
Yeah, bad news for export. I mean, there's a lag effect.
Of course, exports.
Exports, because the entire growth...
Imports, because it's going to put pressure on the Indian rupee.
Yeah, I mean, exports and imports are linked. That's where the trade comes into play. We had, by and large, been able to keep our CAD under, under check, but that's going to go for a toss. Your internal domestic, fiscal deficit is going for a toss. Your capex is not firing the way it should happen, and there is a limitation to government spending. In Indian case, the government spending has, so to say, done the heavy lifting, but for how long? Once the government, whichever wins, comes back, they will have a, coffer which may not be looking very bright.
Right, absolutely. Okay, coffer not looking very bright, but let's hope that some positivity, some silver lining emerges from these dark clouds engulfing all of the world, especially the West. India, thus far insulated. Let's hope we continue to stay insulated to as much a degree as possible.